Hi everybody, welcome back to the 10th of an hour with Griffin Bridgers. For today's episode 91, we're going to look at a continuation of many discussions we've had about situations where a trust is an IRA beneficiary, and we're going to take a brief look at how powers of appointment can affect the outcome depending on what type of trust is in play. And we'll briefly look at how this was treated before and after the Secure Act as well. Now, as always, this presentation is not intended to substitute for legal or tax advice and is for educational purposes only. So, I rehearse these rules every time we look at a discussion on trusts as IRA beneficiaries, but even post-Secure Act, the Treasury regulations contain the trust look-through rules under Code Section 401A9. And these rules allow a trust to be an IRA beneficiary if, amongst other requirements, you can look through the trust to determine one individual trust beneficiary who has the shortest life expectancy. So, in terms of how you do so, a lot will depend on what type of trust you have. These look-through rules and the Treasury regulations associated create two types of essentially IRA trusts, one being a conduit trust and the other being accumulation trusts. Now, a conduit trust is a trust where it's like a leaky bucket. Any IRA distribution has to be spit out to that one individual trust beneficiary who had the shortest life expectancy. Whereas an accumulation trust allows you to accumulate IRA distributions for the benefit of other beneficiaries who may have longer or shorter life expectancies, or who may even be entities which would mandate the 5-year payout rule for the IRA itself. So with an accumulation trust, the problem is you have to take into account every single potential beneficiary under the sun. Now, we've talked about how things like contingent remainder clauses and payments of trust expenses maybe to an estate could throw a wrench in the works and cause a failure of these look-through rules. But another situation that could arise would be a power of appointment, a situation where maybe the individual beneficiary of that conduit trust or accumulation trust could appoint those trust assets, including any IRA distributions or the IRA itself, to a beneficiary with a even shorter or longer life expectancy, or even to an entity. In the worst case, this would cause the 5-year rule to apply as well. Now, there is a private letter ruling back in 2017 that kind of looked at this, one in a long lines of rulings that really kind of considered the power of appointment issue, but PLR 2017-50004 had a situation where the decedent's daughter was the sole income beneficiary of a designated beneficiary trust that was intended to qualify as a conduit trust. Now, aside from the actual ruling in this letter ruling, one thing I noted in the facts is that the trust language stated that the required minimum distribution needed to pass through to the daughter in this case, and the IRS said that's enough to treat it as a conduit trust without really digging into it. But technically, that type of language is incorrect. If you want this to work as a conduit trust, you need to have language that says any IRA distribution has to be spit back out to that individual beneficiary with the shortest life expectancy. But regardless of that technical issue there, the other trust provisions stated that the daughter was to receive all trust assets at age 30, and if she died prior to attaining the age of 30, she had a testamentary general power of appointment that could be exercised in favor of any person or entity. And recall, if entities can benefit from IRA distributions, then you have a 5-year rule that will apply to the payout. Now, in this ruling, determined that the designated beneficiary trust had the appropriate conduit trust provisions, so the general power of appointment was of no consequence. They didn't have to consider whether that power of appointment could be exercised in favor of a person with a shorter life expectancy or in favor of an entity. And really what the IRS did is dig into the fact that no IRA distributions could accumulate in the trust. So because there was no accumulation of IRA distributions, the general power of appointment couldn't apply to those accumulated IRA distributions. Otherwise, if this had not been a conduit trust, the general power of appointment would have caused the 5-year rule to apply because it could have been exercised in favor of any entity. Now, this ruling came out prior to the Secure Act. After the Secure Act, it could take up many tenths of an hour to really walk through the permutations. The one thing I want to note is that all the Secure Act changed is Code Section 401A9. It didn't change any of the Treasury regulations associated with it. And the trust look-through rules, especially as determines conduit trusts versus accumulation trusts, are still contained in those unchanged Treasury regulations. So technically, in this case, the conduit trust provisions could have still applied to prevent the 5-year rule from determining IRA distributions, even with the intervening power of appointment. But we have a situation now where post-Secure Act, with any sort of conduit trust, if the 10-year rule applies, then that means the entire IRA would be essentially liquidated no later than the end of year 10. And if you have conduit trust provisions, what that means is that the entire IRA balance has to be distributed out to that individual beneficiary with the shortest life expectancy, which is a bad outcome if you want that trust to stay intact for asset protection purposes and for management purposes. Otherwise, you might as well have just named the individual beneficiary as the direct beneficiary. So from there, there's a huge rabbit hole we can go down, just because there's about 3 different permutations of how you structure a trust now with an eligible designated beneficiary. I put that in quotes because with an eligible designated beneficiary, that's the only individual that you can now use the life expectancy payout rules for under a trust. But any other beneficiary would have issues. And I mentioned that there's 3 different ways to structure that eligible designated beneficiary because there's 3 permutations. One would be a minor child, the other would be a beneficiary who's disabled, and the other would be an older beneficiary or a spouse. The older beneficiary or a spouse would probably still benefit from the old conduit trust regime. A disabled beneficiary gets the benefit of a new statutory regime under Code Section 401A9. But in the case of a child who's under the age of majority when this payout happens, the Secure Act now says that the trust can no longer use a life expectancy payout calculation when the child reaches the age of majority, which could be anywhere from age 18 to 26. And a lot of guidance out there, especially from Natalie Choate, is suggesting that you probably would not be able to convert a conduit trust to an accumulation trust when the child reaches the age of majority. So lots of different ways we can take this, but for the time being, it helps to keep in mind what happens with a power of appointment within a trust even after the Secure Act. Now, as always, if you have questions or topic suggestions, you can email those to me at griffin.bridgers@gmail.com. Thank you for listening to this episode of the 10th of an Hour, and I look forward to seeing you in the next one.